So if the Brics is successful in the process, first of de-dollarization and then of launching an alternative currency, which either directly or indirectly will be backed by gold, America won't want to see its hegemony being destroyed. So, as in the fall of all empires, actually, other than the British one, which was by diplomacy, it's likely to be a war. And I think the risk of a war by the early 2030s is very real.
In recent discussions on the world stage, various experts have shared their insights on critical global developments, including the situation in the Middle East, the outcomes of the recent Fed and FOMC meeting, concerns about economic depression, and the potential role of gold in backing an alternative currency. Renowned economic analyst SimonHunt has expressed pragmatic impressions of the world, mainly focusing on the evolving dynamics in the Middle East. Hunt emphasized the efforts of Brics nations, Brazil, Russia, India, China, and South Africa, to create a new financial system independent of the US dollar. This move is driven by the desire to establish a multipolar world where power is distributed among several nations, challenging the historical dominance of the United States through military influence and the global use of the dollar. Hunt pointed out that if Brics succeeds in creating a new currency, potentially backed by gold, it could pose a challenge to the U.S., which may be reluctant to relinquish its dominant position in the global financial system. This sentiment aligns with President Vladimir Putin's recent criticism of the West's emphasis on a rules-based world order and his commitment to pursuing a fair world order, as announced for the upcoming Brics summit in 2024 under Russia's presidency. At the New Orleans Investment Conference, financial expert Jim Rickards shared his perspective on the feasibility of a gold-backed Brics currency. Rickards highlighted that the Brics Plus bloc, consisting of 11 nations, holds significant global resources, representing 15% of gold reserves, 30% of land, 40% of the world's population, and 54% of its GDP. This underscores the potential economic influence of Brics in reshaping the international financial landscape. However, not all experts share the same optimism. In an interview with the Investing News Network, Jeffrey Christian, managing partner at CPM Group, expressed skepticism about the possibility of a Brics currency, especially one backed by gold. As these discussions unfold, will there be an announcement of a gold-backed currency by Brics, or a similar coalition in the coming year? What are your thoughts on this? Let's delve into key moments from SimonHunt's interview with these video clips.
I think it's pretty clear we are seeing the last leg of an empire. It takes years for empires to fail. I mean, really what we have is a group of nations under the banner of Brics who want to develop a system that is outside the dollar-denominated one, because they all have had bad experiences, and they want to develop a multipolar world as opposed to the unilateral world that America has run and has dominated through military prowess and its currency being the sole reserve currency of the world. So if the Brics is successful in the process, first of de-dollarization and then of launching an alternative currency, which either directly or indirectly will be backed by gold, America won't want to see its hegemony being destroyed. The fall of all empires, actually, other than the British one, which was by diplomacy, it's likely to be a war. And I think the risk of a war by the early 2030s is very real.
What has changed since the summer, and how confident are you in the economy these days?
I think very little has changed from what we were saying back in the middle of the year, which is that during the first quarter of next year, America and most of the rest of the world will be in recession. You have to ask the question, why did the Fed yesterday come out to be so dovish? The answer is very simple, that they are seeing what we've said will happen, that there will be a recession, and that the recession will start earlier than a lot of people have been saying. So what are the consequences of that? It means that the current rally that we are seeing in base metals and gold, well, let's say base metals, is probably premature. Demand continues to fall. Physical consumption continues to fall. If you look at copper, you would have thought that given the announcements of mine closures and cutbacks in production for next year, that the contango would narrow. It hasn't. It's widened, which means that the trade is saying there's plenty of physical copper around. So really what we're saying on the copper story is don't buy into this current rally, which will probably take us up to 88 odd hundred, because in the first quarter, we're going to see big falls. What we will see the middle of the year onwards will be the real cyclical rally, where we will see a doubling in the price. So coming back to the macro situation, we will see probably either in March or April, certainly in that period, we will see the Fed being forced to pivot, not only because of recessionary trends, not only because the White House wants to see a strong recovery for political reasons, but also because by then we are probably going to see an extension of the war between Israel and Hamas, going to a war between Israel and Hezbollah. There have already been skirmishes from both sides, but listening to Israeli television and very high-level retired IDF intelligence officers, the common enemy is Hezbollah as well as Hamas, and in addition, Iran. So I think the next step that we will see is a serious attack by Israel on Hezbollah. That is going to, again, this is another reason why the Fed will be forced into pivoting, cutting rates, and putting their feet firmly on the credit pedal.
A recent report from the Labor Department on Tuesday revealed that the Consumer Price Index inched up by 0.1% in November, marking a 3.1% increase from the previous year. However, SimonHunt has cast doubt on the accuracy of these figures, suggesting that the CPI, historically considered a reliable measure, may have been manipulated over the years. Hunt points to alternative sources such as the Shadow Government Statistics and the Chapwood Survey, which propose a considerably higher real inflation rate of around 10%, sharply contrasting with the officially reported numbers. Amid growing inflation concerns, the U.S. 10-year Treasury note yield is 3.9%, reminiscent of July lows. Traders anticipate a Fed interest rate cut next year, spurred by a 75 basis points signal. 68% of investors expect the first cut by March. SimonHunt criticizes inflation figures and predicts a significant shift, foreseeing the U.S. 10-year yield rising to over 5% early next year. This projection hinges on anticipated Federal Reserve policy adjustments, highlighting the interconnected inflation and interest rates concerns in the dynamic economic landscape. Let's get back to the interview.
The U.S. Treasury market is really the seat of all the problems because treasuries are so widely held in and outside America and in such quantities. I think the Treasury market has been in trouble for some time. The first big problem was in March when you had the failure of some regional banks. I think that the bond market tells the real story. The equity market doesn't always. The long end of the bond market, 10-year treasuries plus, the Fed has very limited control. So it's the bond vigilantes who really run that market. And in America, forget the published CPI numbers and their derivatives. They're all mumbo jumbo, because back in the 70s, when Arthur Burns was chairman of the Fed, he started playing around with the CPI numbers because He didn't want to raise rates. Most governments since then have manipulated the workings of the CPI. So there's a friend called John Williams who runs an outfit called Shadow Government Statistics that takes back CPI to the original workings, to where they should be today. And in round numbers, in September, October this year, the real CPI number is around 10%. Now, there's another outfit called the Chatwood Survey, which began life in 2017. And the Chatwood surveys 500 items twice a year in 50 different towns and cities. Same items every time. And they're items that households buy all the time. And in the first half of this year, their inflation number was 9.8%. And if you go back for the average since they were formed, started in 2017, it's 11.2%. So you can safely say the real inflation that households feel is around 10%, not 2, 3, 4, or 5%. So the bond vigilantes know this. We will probably see early next year US Treasury 10-year yield rising to over 5%. When the Fed pivots, either late first quarter, early second quarter, then 10 years will fall again, but in the second half of the year, because the dollar will be falling, official inflation will be rising. The real inflation will be, by mid-2025, be running at over 10%. And we will see a resurgence in 10-year yields rising to over 10%, either by the end of this year or by the end of 2024, or by the middle of 2025. And that will be enough to kill off a highly leveraged global financial system, which will result in what we call 7 years of rolling recessions, or indeed depression.
How do geopolitical factors, such as tensions in the Middle East that Simon predicts, factor into the Federal Reserve's decision-making and the potential impacts on the U.S. Treasury market and global financial stability? In a highly leveraged global financial system potentially facing challenges, how might policymakers respond? And what measures could be taken to mitigate the risk of rolling recessions or a depression, as Simon suggests? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.